Hey, good morning, everybody. It's Hammer. Today is Thursday, June 5th, 2025. I, of course, am here to talk about what's going on with mortgage rates and pricing. This show is generally for mortgage loan originators, although I do know that some consumers watch it. I hope it's good for you, and some others as well, which I appreciate you. I got to meet quite a few people yesterday that watched. So anyway, if you are in Atlanta, make sure you come up and say hello to me today. I'll be there this afternoon and, of course, tomorrow. But if you're not in Atlanta, say hello while you are live. Give me a hashtag live in the comments. Let me know that you're here. And this morning, we're going to talk about why rates improved yesterday and how long it's going to last, right? We're going to talk about tomorrow's BLS jobs data, and we're going to go into where things will be over the next few weeks and what the next big thing will move rates. So remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Like I said, this morning, coming to you from Atlanta. It's a little overcast out there today. I don't know what you guys see. I'm just turning against the window. This is me facing out there, looking out at the window, and from the 10th floor here. And I'm glad I don't live in the city. I'm not a city mouse. I'm a country mouse. So anyway, if you're in the Atlanta area, if you live around here or something, let me know in the comments. I'm curious. Also, if you are here watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. If you are on Facebook, give us a thumbs up, maybe tag an originator in the comments. If you're on YouTube, make sure you go ahead and subscribe and click that thumbs up and all that good stuff. You guys know all those social things that they try to get you to do for the algorithm. If you would like a reminder that I am going live to your cell phone each morning, I do send out a quick text message. You can unsubscribe at any time, and we don't share your information with anybody, of course. So it's hmmr.io/reminder, or use this cool QR code. If you snap a screenshot with your phone, you can go back later into your pictures, and it will still work, that QR code, which I think is the coolest thing ever. So if you're here this morning, say good morning. Yesterday, I didn't get to say hello to my friends. So today, I'm definitely going to do it. Curious if my friend Allison Foy is on. I did meet Moselle yesterday. So, and she said hello, and I wish I could see you in person. Too bad you couldn't make it, but Mallory Fotiatis, good morning. Ron Siegel, great to see you. Bill Stevens, Mike Tebow, Amy Blauser, Bobby J. Jones, great to have you all here. Mike Brown and Kenny Rivard, Megan Bissell, Deb Dickinson, Bill Stevens is from Mortgage DMZ in Michigan. All right, man. Appreciate you up there. Tim Kyle is also up in Michigan, as is Mike Tebow. Julia Lawrence, good morning. Kyle Mazik, it's great to have you. Carly Overfelt McLeod, hello. Yasmin Martin, woohoo! You're Marietta? I would think you're a Georgia girl. I could believe that. Ron Siegel, Les Parker is forecasting 3.6 10-year by September. No way. No way. I don't think. Do you think so? I don't think so. We would have to see some crazy weak economic data. We have to see inflation dropping. We'd have to see so many things happening. I don't see happening, especially with the timing of the one big bloated bill. Even Elon says that this thing is ugly and Americans should push back on it. I don't think that's going to happen. Who thinks that could happen? Good morning, Sean Segaloff. Good to see you, sir. Who thinks that we could see a 3.6 10-year? I don't think so. So, all right, well, let's jump into it. All right, welcome to everybody. Let's go ahead and get there. Quick recap on what happened yesterday. Let me go ahead and share the screen. We'll jump over to the other side. So, taking a look here. Sorry, I don't have Presentify up on this monitor, so I can't draw pretty yellow lines for you. We'll do that maybe tomorrow. But if we take a look here, as Ron Siegel pointed out yesterday, the ADP data came out at 8:15. So we opened the day yesterday at 8 a.m., around 98.80. At 8:15, it was, 10 basis points higher than that, and it pushed up until 8:30. We saw up to like 99. So we got quite a nice little bump here. And then it it came back. And that's why I don't think the ADP is really that big of a deal. I think it gets too much credit for yesterday's improvement. I know that Matt Graham was referencing it. Not that he put the end all do, but he did point out. I mean, arguably, was it causality or just coincidence? You do see some of it here. However, the ISM data that came out yesterday, 9:45 and 10 a.m., that I think had a much stronger effect on what was going on here. Came in showing economic weakness, more weakness than expected. That stacks on to the previous day's weakness in data as well. So you take a look at this, and we've seen bonds really improve. A couple of big takeaways. Yesterday's improvement here. Let's go ahead and put this on like the 2-day. This drop. I'm gonna put this to a line chart for a minute so it's a little easier to see. But let's do 5 days so you can actually see it right there. So I mean, this drop that we've seen in the 10-year yesterday, that was the biggest drop since April, and it did break the bonds, the 10-year and mortgage-backed securities, but the 10-year, it broke them out of a range that we have seen and gone over a couple of different times. So actually, that's way too long. Let's do 3 minutes. So taking a look here, I had been pointing out, if you look at the green line, here, not the green candlestick, but the green line, the 100-day moving average, that we have not seen the 10-year break below the 100-day moving average. This is all the way back in the middle of May. And I wouldn't have expected to see this strong of a move from yesterday's data. I would have expected it if we get weak labor market data tomorrow. All right. This morning, jobless claims. Let's take a look and see where jobless claims came in this morning. I think they came in a little bit weaker, showing a little bit of economic weakness. Highest level since October. So that's also another red flag for the labor market. And remember, the reason we're watching the labor market so closely is because the Fed, I'm going to stop sharing for a minute. The reason we're watching the labor market so closely is because the Fed's mandate is to keep price stability, which is inflation, and maximize employment, which is labor market. So tomorrow's BLS jobs data. I thought if you had asked me, and I asked myself, if you had asked me yesterday in the morning, I thought that this BLS jobs report would have less of an effect on markets than normal, that markets were not going to react too strongly to the data. However, seeing the reaction that we got yesterday in bonds based on the ADP data coming in late. Remember, the ADP data, it's the number of private payrolls created. And if nothing else, I love that number because it's a real number. ADP is not a government agency doing surveys. ADP is a payroll company, and they're probably still the largest, although they're not quite as large as they used to be. As far as market share, the ADP payroll data is how many private payrolls are being created, right? How many private jobs, and it's a real number. And it's based on payroll run. It's based on how many checks they're cutting. The direct deposit, you get the whole thing, but the premise. And the fact that that's lower does not mean that the BLS jobs data on Friday is going to be any lower. Don't let that fool you. Don't use that as a prelim. Remember, what we're going to get with the BLS jobs data tomorrow, there's two components to tomorrow's data. There's the household survey and the business survey. The household survey is exactly that. Imagine them calling up, ring, 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 ring. I got a hotel phone, so this is old school, right? I like that. Ring, ring, and they're asking people, hey, do you have a job? Are you looking for a job? Do you want to be employed, basically, right? So first question is, do you have a job? Yes or no. If they have a job, they're employed. If they don't have a job, they're not necessarily unemployed. How does that make sense, Hammer? Because if they're not looking for a job, they're not participating in the job market. That's why we look at what we call the participation rate. Who's not looking for a job? Could be retired. They could be on meth. They could be on assistance, right? But for whatever reason, they're not looking for a job. So therefore, they're not actually unemployed, because even though they don't have a job, because they're not looking for a job. So that's your household survey. That's where you get your unemployment number and the participation rate. Now, the business survey is they're ringing up and contacting businesses and basically looking at, how many jobs did you create in payroll data, right? So they're looking how many jobs, how many new non-farm, that's the thing too, right? They're not farm jobs. And I guess at one time we probably had a lot of farm jobs, but I know there's still a lot, but not nearly. But yet there's still non-farm payroll, right? So how many jobs were created? And then there's seasonal adjustments. And this is the one that all of us tend to think I don't want to say it's manipulated, but I think it's inaccurate. And then that'll be revised for the next 2 months. And then they do a revision at the end of the year. So it's a highly revised number. And as many of y'all have pointed out, we only get a reaction to the initial, I'm glad I made you laugh, Robert, to the initial data. So Friday's jobs data, what should we be doing with loans going into tomorrow? Now, again, if I had known that rate sheets were going to be better today like they are, and let's take a look at Mortgage News Daily. I'm going to go ahead and pull this up and show you what we got going on here. Let's take a look here and use Mortgage News Daily as the reference point. So, 6.87 compared to 6.96, it's barely an eighth in rate. It's generally going to be more of an improvement in pricing, but it is one of the nicest improvements we've seen. We had a negative 0.09 move back in May. We had a 0.7 negative, but as far as positives go, we haven't seen that kind of move, and we haven't seen 6.87. Closest we got was 6.88 right here, and that was back at the beginning of May. So we haven't seen it since April, and we did see it in April, like 6.86 and stuff. But so this is actually the bottom of the range, and it does put us into a bit of a quandary, and it shows a couple of things. Again, number one, if we take a look at mortgage-backed securities and look here, you can see that we broke through. You can see right here that we broke through the resistance levels, the technical resistance. Now, we were coming up on a convergence of this red, the 50-day moving average. The green line is the 100-day moving average. And before yesterday, we were way, way below. It's about 20 basis points, 18 basis points maybe. We were way below that number. And we've been below that number since going back to the beginning of May, right back here. So remember, if we're coming down, that's good for rates and pricing. And when we hit these lines and bounce up, that's technical resistance. Or support rather, because we want when down is bad, we're at mortgage bonds. I know I'm getting all cooped up here. So this is not the 10-year treasury yield where down is good. These are bond prices. So this is support, and we want to bounce above that. Now, we broke below it and we stayed below it, and that was kind of our range. You look at these levels, and that's when you're looking at the technicals. The fact that yesterday broke above it so convincingly and let me refresh this so we get the right color candlestick there, because we're up 4 basis points. So when you look at where we've broken above that today, that's a big deal that bonds are above this. So hold on, let me just click out of this for a second so I can get it to, there we go, so I can get my pointer back. So the fact that we saw a very strong reaction that broke through the technicals shows an underlying, I'm going to call it, it shows like an underlying eagerness from markets. Do I have that on there? Yeah, I do. Where did I have that? I had that here, where it was like an underlying eagerness by markets where things have, they're looking for that improvement. So tomorrow's BLS jobs data, if it does come in showing weakness, based on yesterday's bond reaction, we could see continued improvement, a lot more so than I was expecting. Remember, yesterday afternoon, nobody asked me, so I asked myself. I did not think that Friday's data would see much movement. I thought that markets were pretty calm about what's going on. Now, take a look at the expectation for Fed rate cuts. This is interesting to me, and I want to share it with you. So expectations of a cut at the June meeting in a couple weeks, still 0%. Right now, the Fed funds rate is between 4.25 and 4.5. And that's exactly where it's expected to stay. There's no change there. But let's jump to the end of the year. Right now, expectations that rates will be exactly where they are now, very, very small. We're going to call this one non-existent. We're going to X that out altogether. The fact that we will only, or the possibility that we will only see one rate cut, there's a little bit of an outlying, belief about that. Now, the probability that we will see 2 rate cuts, 2 quarter-point rate cuts. And remember, how many meetings do we have? If we don't see a cut in June, we've got July, September, October, December. There's 4 meetings left this year for the Fed. Markets are betting about a 38% probability that in those 4 meetings, we'll see 2 quarter-point rate cuts. There's a 35% expectation that we will see 3 out of those 4 meetings with a quarter-point rate cut. There's really no expectation of a half-point cut in here. A half-point cut would be a bigger cut, would signal much more concern about the economy. We would have to see some really, really weak economic data and very alarming unemployment going up to see that kind of happen here, right? Now, I wanted to hit the compare feature here and show you this. If we look a week ago, it was 25% probability that we would see 1 cut. That's dropped down now to 16%. And a week ago, it was a 25% probability that we would see 3 cuts. That's now up to 35%. So the 10% we lost here, basically, it trickled over and trickled over. So that trickles to the expectation of 2 cuts, and that trickles over to the expectation of 3 cuts. But 2 cuts, still the overwhelming favorite. 40% a week ago, 38% yesterday, 38% today. However, a month ago, it was 23%, and the expectation was for at least 3 cuts and maybe even 4 cuts. That was just a month ago. So when you see rates and pricing and expectation, how it corresponds to the probabilities and what markets are pricing in for Fed rate cuts, that's how that all comes into play. So today, I think we're going to see a pretty quiet day today. Right now, we're up 3 basis points. I don't think you're going to see big losses. I don't think you're going to see yesterday's go away. What's going to happen today? Oh, you know what? I had my head on there, so you guys may not be able to see anything. I'm sorry. Well, anyway, you guys know where I'm coming from. So I think what's going to happen today is it's going to be a quiet day. Now, tomorrow's BLS jobs data. Most loans, let's say that you've got consumers that are closing later in June or early July. You have to look at risk tolerance, because if we get data that surprises the market to the upside and it's stronger than expected, you're going to see a negative reaction, and you'll see some pullback on that expectation of Fed activity and what economic activity will be. It's going to be very, very reactive. Now, the one thing to take into note, though, is how long will that reaction last? Will it send us onto a rate rally? Will it send us onto a big sell-off? Probably not. All right. Now next Wednesday, we get the CPI inflation report. The last 2 CPI inflation reports have come in slightly better than expected, or at least that expectation is lowering inflation. This one is expected to start showing some of the tariff inflation, and then the next one we'll see even more. But how bad is that inflation really? That's the question. How much does that inflation show up in the basket of goods that are the CPI? I think it's like 250 or 280 goods that they track for the CPI. So how much of that is going to show up? So if we get weak labor data and weak or cooling inflation data, we could see bonds continue to improve a little bit. And again, we're not going to see rates drop tremendously, y'all. And we're almost majoring in the minors. Do I wish that I had told you to float on Monday if I had a crystal ball? Absolutely. I would have said to float. But based on conditions, wasn't expecting to see the breakout that we saw yesterday. That was a very odd reaction. And that's why it has to catch our attention. It's kind of a red flag reaction. So we want to see what happened with that. But when we take a look at where things are going to go, there's really a floor to where rates are going to go. They're not going to drop into the sixes, low 6s, 6.25, like we saw back in September of last year, unless we get extended, pronounced economic data. The talk of recession increases again. The trade war drama stuff starts to settle down. And importantly, bill, because for bonds, that big bloated bill is still hanging like one of the cartoons. It's hanging like a safe over our head on a little rope that's popping off, right? Little pieces of the rope are popping off. And am I forming this picture in your brain properly? Let me know in the comments if you see this. It's like those Warner Brothers cartoons where the safe is dangling and the line for the safe. Oops, hold on. I pulled that line and dropped the whole thing down. But the line for the safe is, frayed, and it's just kind of dangling here. and it's a frayed rope, and it's kind of getting ready to drop. And the problem with the big bloated bill is the expectation that it's going to create even more of a deficit, and they're going to have to borrow more money to pay for it. So that's why that's a big drag on bonds, and it will be. I mean, we're not going to see that thing get done until July, right? They're looking to have it done by July 4th. It has to get approved in the Senate. Then I think, don't quote me, but for something I read this morning, I think it goes back to the House because of the changes that will be made to it in the Senate. The House will have to approve the newer version, then it'll go to Trump to sign. So, yeah, Mike Brown, you feel like the Roadrunner. That's exactly it, baby. Good morning, Tony Fitzgerald, Casey Roberts, Laura McCain. Great to have you all here. So, Ron Siegel, the BLS definition of a job is 1 hour of work for pay. Hey, well, you know what? That's 1 hour more than some people have made. So, anyway, that's why I'm at where I'm at right now. You have to decide if loans are closing in the next couple of weeks. If we do see a reaction tomorrow, how long will that reaction last? If it's weak, we could see a jump in rate sheets. Could see some of the best pricing you've seen in a while. So keep that in mind. But there is risk. However, if let's say it goes the other way and labor market strength, well, then we're going to lose all yesterday's gains probably, and we probably go back to, and let me share the screen again and we'll kind of talk about this. If we see stronger labor market data tomorrow morning, and remember, it comes out before rate sheets, that's the problem here. It probably brings us back to that 6.96, 6.97, 6.98. So you're probably looking at rate sheets from the 28th pricing for the 28th, 29 kind of area. We'll lose yesterday's gains and a little bit more, a hair more maybe. I don't think it'll drive us back up into the sevens, but even if it did like this, we'll definitely come back down. This is where rates are staying, and what we're looking at right now is kind of majoring in the minors. We're looking at the smaller scale. So if you got loans that have more time, 15 to 30 plus days, you could float those, right? I would float them into tomorrow's data based on yesterday's reaction, the changes that we saw, and the fact that we could see some continued improved pricing. And then we'll decide, how do we want to look going into next week's CPI data? CPI data has not set the market spinning in a while, but they could. It always right now in this environment has the potential to set the market spinning and change rate sheets. So anyway, that's what we got going on this morning. I hope this helps y'all. Appreciate you. And I hope you all are having a fantastic day. I'm going to go see all the people over at the Mercedes-Benz Center because I'm still coming to you from my hotel room because I wanted to have some time to just really discuss this and not have a lot of distractions and different things. I don't want to be rushed through today. So hope today helped so much. Appreciate y'all being around. Hope you guys are having a fantastic day. Make sure you join me tomorrow. We're going to talk about what happens with the jobs data. We're going to see, we'll be able to, there won't be any more speculating. We'll be able to see which direction rates are going, and then we'll be able to speculate some more about how long will they stay there. If it gets worse and they're going up, we'll talk about what will bring them down. If they're getting better and they're improving, we'll talk about how long they could stay that way or how long improvement could continue. So again, sorry to be a little wishy-washy, but tomorrow is a total unknown. It looks like we're going to see a stronger reaction than I would have expected earlier in the week, though. So that's a little scary, a little exciting. Could be better for rates, but overall, get out there and get some loans, y'all. It's what we need to do. So I'll catch you later. Hope you guys have a fantastic day. Bye-bye.